Most traders treat $500 like pocket change. They risk it on a hunch, chase it on momentum, lose it before lunch, and call it market noise. But here's the brutal truth that separates amateurs from professionals. The difference isn't account size, it's precision. And precision begins with a number you can't afford to lose carelessly. Stop for a moment and think about what $500 actually represents in your real world. For most people, that's a car payment. It's 2 weeks of groceries. It's a significant portion of rent or mortgage. To earn that money at a regular job, you might work 40 hours of genuine labor. Yet the moment you open your trading platform, you're willing to set that same amount on fire in 30 seconds because you saw a green candle and felt the fear of missing out. You've probably blown through $500 more times than you can count. Not because you're stupid, but because you were never taught the fundamental law of the tape. The market doesn't reward activity, it rewards accuracy. This is the hardest lesson for the modern mind to accept. We're conditioned to believe that effort equals reward. Work harder, earn more. But in trading, the correlation between effort and profit is often inverse. The more you click, the more you bleed. Think back over your last 6 months of trading. How many times have you watched a position drift against you for $300, $400, $500 and justified it as part of the game? You told yourself you'd make it back tomorrow. You told yourself the setup was good. The market just didn't cooperate. But add those hits together across a year, and you'll see something terrifying. It wasn't the big blow-up that killed your account. It was death by $1,500 cuts. Jesse Livermore understood this when he said, "It was never my thinking that made the big money for me. It was always my sitting." But sitting doesn't mean laziness. It means waiting with intent, waiting with rules, waiting for the tape to line up in a way that lets you risk a little to potentially make a lot. Men who can be right and sit tight are uncommon, because sitting feels like doing nothing. And to the amateur, doing nothing feels like losing money. The amateur asks, "How do I make money every day?" The professional asks, "What does the 1-hour chart tell me today?" That difference costs everything. Because while you're jumping between the 5-minute chaos and the daily molasses, the real money is made in the Goldilocks zone, the 1-hour time frame where institutional footprints are clearest and retail noise is filtered out. When you stare at a 1-minute or 5-minute chart, you're not looking at the market. You're looking at algorithmic noise, machines battling for liquidity. You're watching the heart rate of a sprinter, trying to predict where the marathon runner is heading. It's impossible. You get chopped up. You buy breakouts that instantly reverse. You short breakdowns that immediately rally. You're being hunted by systems faster than human reflexes. But the 1-hour chart is different. It's the bridge between day trader noise and position trader trends. Slow enough to filter out the fakeouts, fast enough to give you precise entries. On the 1-hour, you can actually see where institutional money accumulated, where they defended levels, where they shifted from buying to selling. This is what Livermore called reading the tape, just with candles instead of ticker symbols. The 1H ATM strategy isn't about pressing buttons every hour like some broken cash machine. ATM stands for alignment, timing, and management. 3 pillars that turn your screen into a precision instrument when conditions align perfectly. Not a slot machine, not a casino, a methodical extraction system. Here's the counterintuitive promise. You don't print $500 from the market. The market rents it to you and takes it back the second you act like an amateur. Think of the market as a landlord. It temporarily transfers capital to your account, but if you don't have the discipline to keep it, the market will repossess it with interest. Professionals use the 1-hour chart like Livermore used the tape, as a filter, a timing device, a way to wait for the pivotal point where risk is tight and reward is wide. Let me show you the difference in identity. Last month I watched 2 traders with identical $10,000 accounts. Trader A opened his platform every morning asking, "What can I trade today?" He made 11 trades that week, won 4 of them. His win rate was 36%, but that's not why he lost money. He lost money because his average loss was 3 times his average win. By Friday, his account was below $8,000. Trader B opened his platform asking, "What does the structure tell me today?" He took 3 trades that week. 2 winners, 1 loser. Net profit, $400. Same market, same charts, completely different relationship to risk. One was hunting for action. The other was waiting for alignment. Amateurs chase $500. Professionals protect 1%. The 500 becomes a mathematical side effect of disciplined risk cycles, not the desperate goal of a gambler at the machine. When you risk $100 per trade on a $10,000 account, you can be wrong 10 times in a row and still have 90% of your capital. More importantly, you can be right just 3 times with proper reward to risk ratios and make substantial profits while being wrong 70% of the time. This is the secret the $500 graveyard hides. You don't need to be right more often. You need to be right more precisely. You need your wins bigger than your losses, and you need your losses predefined, accepted, and executed without hesitation. The market will give you $500 when you stop demanding it and start earning it through process. In the next chapter, we'll decode the first pillar, alignment, and why trading against the 1-hour structure is financial suicide, even when you're right about direction. Because being right about where the market is going means nothing if you're wrong about when it's going there. Imagine standing on the bank of a raging river. The water is dark, heavy, and crashing downstream at 50 miles per hour. You can feel the vibration of the current through the soles of your shoes. The sound is deafening. Foam, debris, and waves slam against the rocks with relentless force. The amateur trader looks at that violent torrent and thinks, I can swim upstream. I'm strong enough. I can beat this force. They jump in, stroke harder than anyone else, fight with every ounce of their strength, and they drown within minutes. They didn't drown because they were weak. They didn't drown because they lacked effort. They drowned because they fought the laws of physics. Now picture the professional. The professional looks at that same river, assesses its power, drops a raft into the water, positions it correctly, and lets the massive current carry them straight to the profit target. They barely break a sweat. They arrive faster, safer, and richer. Same river, completely different relationship to the force. This is alignment, the A in our ATM strategy. It is the single most important filter in your trading arsenal, and it will save you more money than any indicator you'll ever buy. Before you ever look for a specific entry candle, before you calculate position size, before you even think about pressing a button, you must answer one fundamental question with complete honesty. Who controls the tape right now? Is it the buyers or is it the sellers? Most amateurs try to answer that question on a 1-minute or 5-minute chart. Every candle feels like life or death. A green bar appears and they scream, uptrend. 2 minutes later, a red bar prints and they reverse their entire thesis. Their bias changes with every blip of volatility. The problem is simple. On those tiny time frames, you're not reading the market. You're reading noise. You're trying to hear a symphony through a broken speaker, trying to understand the ocean by staring at individual waves crashing on the shore. Professionals step back. They know the 1-hour chart shows the real story, not the mood swing, the story. On the 1-hour time frame, you can see whether price is consistently making higher highs and higher lows, or lower highs and lower lows. That is structure. That is who owns the tape. Market structure is simple in concept, but requires discipline to respect. If we see a series of higher highs and higher lows, buyers own it. They've been able to push price to new peaks, and every time sellers try to knock it down, they can't push it as low as before. The market is literally printing confidence on the chart, showing you that demand is stronger than supply. In that environment, you have no business trying to be the hero who shorts every rally. You're standing in front of a freight train, hoping your ego can stop tons of steel moving at full speed. Flip it around. Lower lows and lower highs means sellers own the field. Every rally is weaker than the one before. Every dip slices lower than the previous low. The professional doesn't argue with this reality. They don't say, it's too low, it has to bounce. They accept what the tape is writing. Downtrend means you look for short opportunities, or you step aside completely. You do not try to catch a falling knife with your bare hands. Here's the non-negotiable rule that will save you thousands of dollars over your career. We never trade against the 1-hour structure. Ever. Not because it never works, but because when it doesn't work, it destroys you completely. You might catch a counter-trend bounce once or twice and feel like a genius. But sooner or later, you'll step in front of a genuine trend leg, size up with confidence from your past success, and the market will erase weeks or months of progress in a single afternoon. I once watched a trader blow a $10,000 account in a single session, doing exactly that. The stock had been in a ferocious uptrend for 3 days, ripping higher hour after hour. The 1-hour chart was textbook bullish, higher highs, higher lows, clean stair-step structure climbing relentlessly. He looked at the vertical move and said, "It's gone too high. It has to come down." Notice the words he used. Has to. That's not analysis. That's hope dressed as logic. He shorted at 11 in the morning. The stock went against him immediately. Instead of cutting the loss, he said, "It's even more overextended now," and added more size. He fought the current. Every time the 1-hour printed a new swing high, he told himself it was finally the top. By the close, he wasn't trading anymore. He was praying. The market doesn't hear prayers, it only hears orders. By the time he finally surrendered, his $10,000 account was cut in half. He hadn't traded the chart. He had traded his opinion against the tape. The market can remain irrational longer than you can remain solvent. Keynes said it, but Livermore lived it every single day. You are not paid to be early. You are not paid to be contrarian. You are paid to be aligned with the dominant force. But structure on one time frame isn't enough for the 1H ATM strategy. This is where most traders make their second critical mistake. They see an uptrend on the 1-hour chart and immediately start looking for long entries, completely ignoring what the larger time frame is telling them. We demand confluence. Confluence means agreement. We want the 1-hour trend to match the 4-hour bias. When these time frames align, you're no longer gambling. You're surfing the same wave as institutional money. Think about how large players operate. Hedge funds and proprietary trading desks don't slam in full size on a 5-minute impulse. They analyze the 4-hour and daily charts to determine the major trend, then use the 1-hour to time their precision entries. They accumulate positions over hours, sometimes days. That behavior shows up most clearly on the 4-hour chart as broad swings, major levels, and the dominant direction of bigger capital. But they don't execute all their entries off that 4-hour time frame alone. They drill down to the 1-hour for timing. 4-hour sets the background music. 1-hour gives you the beat to dance to. Picture the 4-hour chart as the tide, and the 1-hour chart as the waves. When the tide is coming in and the waves are crashing in the same direction, you have the entire ocean behind your trade. When the 4-hour chart shows accumulation and the 1-hour chart shifts into an uptrend, you are no longer gambling. You are aligning yourself with Goldman Sachs desks, hedge fund algorithms, and central bank flows. Professional money moves in waves across multiple time frames. If the 4-hour chart is bearish, but the 1-hour chart is bullish, what do? You do nothing. You sit on your hands. This is what we call a civil war in the market. The time frames are fighting each other. When the generals are fighting the lieutenants, the soldiers get slaughtered. We wait for peace. We wait for alignment. But here's the subtle trap that catches even smart traders. They finally accept the concept of trend following. They identify the correct trend. They see both the 1-hour and 4-hour pointing in the same direction. They enter the trade, and they still lose money consistently. Why? Because they enter when the move is exhausted instead of when it's gathering energy. Picture this scenario. The 1-hour chart has been climbing steadily for hours. Price is now at the very top of that move, miles above the last swing low, stretching away from any logical support level. You see the alignment and jump in because you finally made peace with trend as your friend. But what did you actually do? You bought the scream. You bought the top of the river's wave, just as it's about to crash and pull back. You're technically aligned with direction, but totally misaligned with timing. The professional sees the same chart and does nothing. They say, yes, buyers are in control. Yes, both time frames agree, but this is not my spot. They understand that markets breathe. Every trend inhales and exhales. It surges, then retraces, pushes, then pauses. A rally is the exhale. A pullback is the inhale. You cannot exhale forever without taking a breath. The amateur chases the exhale at maximum extension. The professional waits patiently for the inhale, positioning themselves for the next powerful exhale. Think of it like an auction. The price of an item keeps climbing. $20, $30, $40. The amateur jumps in at $40 because they're afraid it'll go to $50 and they'll miss out completely. The professional waits. The bidding pauses. Someone drops out. The price dips back to $35. That's when the professional bids. Same item, better price, lower risk, higher probability of profit. Alignment is about probability stacking, not fortune telling. When the 1 hour says up and the 4 hour says up, you have mathematical wind at your back. Your wins can run because the current is strong. Your losses get stopped out quickly because the market doesn't reverse far against a genuine trend. But if you trade against the structure, your wins are small because the market keeps pushing against you. Your losses are large because you keep hoping the trend will reverse, and it doesn't. There is profound power in doing nothing when conditions aren't perfect. Most people think trading is about activity. They think if they aren't in a position, they aren't working. That's the employee mindset creeping into your trading psychology. In trading, you are the casino owner. You don't play every hand dealt. You only play when the odds are so heavily stacked in your favor that losing becomes statistically unlikely over time. If the 1 hour and 4 hour disagree, you do nothing. That nothing is not weakness. It's not cowardice. It is an active, profitable position because you are preserving capital for when all conditions align perfectly. Waiting is a position. Cash is a position. The best traders in the world spend most of their time doing nothing. And that nothing is what allows them to compound wealth when the perfect setup finally appears. Look at your past month of trades and ask yourself a brutal question. How many of those trades did you take when the 1 hour and 4 hour were clearly aligned in one direction? And how many did you force in choppy, sideways, or conflicting markets because you felt bored, anxious, or behind on your weekly profit target? That answer alone will tell you if you're swimming with the current or fist-fighting the river. Alignment is the foundation of everything that follows. Without it, your timing doesn't matter. Your risk management doesn't matter. You're building a house on sand during an earthquake. But with proper alignment, with confluence between time frames, with clear structure that you can point to without squinting or forcing the picture, you've stacked the first critical layer of probability in your favor. We don't want to be perfect. We want to be profitable. We want easy money, not hard money. Hard money is fighting the trend for 10 pips and getting stopped out repeatedly. Easy money is identifying the structure, waiting for confluence, and letting the institutional current carry you for 50 pips while you barely lift a finger. So we have established our first pillar. We know who controls the tape. We are watching the 1 hour structure like a hawk, demanding agreement with the 4 hour tide. But knowing the direction is only half the battle. You can be perfectly right about trend direction and still get stopped out if your entry timing is sloppy, if you chase the scream instead of waiting for the breath. Next, we'll decode timing, the second pillar of our ATM strategy. I will show you how to spot the exact pivotal moment when the aligned trend is ready to resume, allowing you to enter with sniper-like precision while the amateurs are still chasing the ghosts of the last green candle. Amateurs chase green candles. They see price spiking violently upward. Their heart rate accelerates. Their palms start sweating, and they slam the buy button at the absolute top of the move driven purely by FOMO. The moment they click buy, the market reverses like it was personally waiting for their order. Within seconds, they're underwater. This keeps happening not because they're unlucky, but because they bought the scream instead of waiting for the breath. Think about how you breathe. You inhale deeply, filling your lungs with oxygen. Then you exhale forcefully. You cannot exhale forever without taking another breath. The market operates identically. In a genuine uptrend, price surges aggressively as buyers flood in with conviction. That's the exhale, the effort. Then price must pull back, must retrace, must consolidate as early buyers take profit and new buyers position for the next leg. That's the inhale, the recovery. Timing, the second pillar of our ATM strategy, is about waiting for the market to inhale before the next powerful exhale higher. It's about positioning yourself at the moment of maximum probability and minimum risk, not the moment of maximum excitement and maximum risk. This distinction alone separates traders who compound wealth from traders who donate their capital to the market month after month. In a healthy uptrend, price never moves in a straight line. It surges, then pulls back. Surges, then pulls back. That pullback isn't the trend dying. It's the trend resting, gathering energy for the next leg up. When you chase the surge, you're paying retail prices at maximum extension. When you wait for the pullback, you're buying wholesale at favorable risk levels. Professionals refuse to pay retail. We don't chase the surge. We wait patiently for price to come back to us, back to a zone where we can define our risk tightly, and where the probability of continuation is mathematically in our favor. We're hunting for a specific zone, previous resistance that has now become support. This is one of the oldest, most reliable concepts in technical analysis, yet most traders completely ignore it in real time because they're too busy chasing the next shiny candle. Picture a stock trading at $48. It consolidates, builds energy, then explodes through $50 on heavy volume. That $50 level was resistance. Every seller who wanted out near 50 got their wish. Now price is trading at $52, $53. The amateur sees this move and buys at 53 because they're afraid it'll run to 60 without them. The professional marks $50 on their chart and waits. They know that if this trend is real, if buyers are truly in control, price will eventually retrace back toward $50, find support there, and launch the next leg higher. Think of it like a staircase. When you walk upstairs, you step on the solid surface of the previous step to lift yourself to the next one. The market does the same. It breaks through a ceiling, climbs higher, then steps back down onto that old ceiling to use it as a floor for the next launch. This is where we do business. This is the only place we do business. Here's the precise mechanical setup you will hunt every single day. First, you have identified the 1-hour trend through alignment. Both 1-hour and 4-hour must be in agreement. Buyers must own the structure. Second, you wait for a pullback to a key level you've already marked on your chart, that old resistance level that should now act as support. Third, and this is critical, you demand the pivotal point, your specific entry trigger that tells you the pullback is complete and the trend is ready to resume. The pivotal point is not a feeling. It's not a guess. It's visual confirmation on the chart. We don't place limit orders blindly at a level and hope it holds. That's catching a falling knife. We wait for the 1-hour candle to close. We demand evidence that buyers have stepped back in with force. We want to see a 1-hour candle with a long rejection wick at that level, often called a hammer or pin bar. What does that wick tell us? It tells a complete story. During that 1-hour period, sellers pushed price down aggressively, testing the support zone. For a while, things looked terrible, but then buyers stepped in with overwhelming force, absorbed all the selling pressure, and pushed price back up, forcing the candle to close near its high. That long lower wick is the footprint of institutional demand. It's the market tipping its hand, the tape saying, sellers tried to push lower, but buyers stepped back in with conviction. Alternatively, we look for a bullish engulfing pattern. The previous candle is red, showing sellers in temporary control during the pullback. But the next candle opens, and buyers come in with such violence that they not only erase the previous candle's losses, but push price higher than where that red candle opened. The entire range of seller pressure gets swallowed by buyer conviction. When you see that engulfing candle close on the 1-hour chart at your key level, you have your pivotal point. Let's get mathematical, because precision in trading isn't about feelings, it's about numbers. You have a $10,000 account. You've committed to the professional standard of risking 1% maximum per trade. 1% of $10,000 equals $100. That's your maximum allowable loss on this trade. Not 150 because you really like the setup. Not 200 because you're confident this time. $100. Period. You've done your homework. You spot alignment. Both the 1-hour and 4-hour charts show clean higher highs and higher lows. Price surged from $48 to $53 over the past several hours. Now it's pulling back. You mark $50 on your chart as previous resistance turns support. You wait. You watch. You do nothing while price drifts lower toward your zone. Price reaches $50. The 1-hour candle opens at $50.10. During the hour, it drops to $49.70, testing the support zone. Amateurs are panicking, closing their longs, convinced the trend is broken. Then in the final 20 minutes, buyers flood in. The candle closes at $50.20. You have a perfect hammer candle with a long lower wick. You have your pivotal point. Now the mathematics. Your entry is $50.20. Your stop loss goes at $49.70, just below the wick low. Why there? Because if price breaks below that wick low, it means buyers failed to defend the level, and your thesis is wrong. You don't argue with wrong. You accept it and move on. The distance from your entry to your stop is 50 cents per share. That's your risk per share. You're allowed to risk $100 total. Simple division. $100 divided by 50 cents per share equals 200 shares. That's your exact position size, not about 200, not close to 200, exactly 200 shares. You buy 200 shares at $50.20. Your total capital at risk is $100, exactly 1% of your account. Your target sits at a minimum 3-to-1 reward to risk ratio. You're risking 50 cents per share, so you're targeting at least $1.50 per share profit. Your entry is $50.20. Add $1.50, and your target sits at $51.70. If price reaches that target, you make $1.50 per share times 200 shares, which equals $300 profit before commissions. You risked 100 to make 300. That's a clean 3R trade. Think about what this mathematical framework gives you. You can be wrong 7 times out of 10 and still be profitable. 7 losses of $100 each equals $700 lost. 3 wins of $300 each equals $900 gained. Net profit, $200 with a 30% win rate. This is why professionals obsess over reward to risk ratios while amateurs obsess over being right. But here's the critical discipline that separates professionals from amateurs. What if price doesn't give you the pivotal point? What if it pulls back to $50, but instead of forming a rejection wick, it just smashes straight through, breaking down to $48 without any pause? You do nothing. You absolutely do nothing. You don't chase it lower trying to short. You don't buy it at 48 hoping for a bounce. You saved your capital. You preserved your $100 for the next proper setup. This is what separates the professional from the amateur in real time. The amateur sees price approach their level and places a limit order, hoping it gets filled. When price blows through, without stopping, they're already in the trade, already losing money, already scrambling to figure out what went wrong. The professional waits for confirmation. They demand the pivotal point. If it doesn't appear, they don't trade. The setup is there or it isn't. It's completely binary. You act with conviction when all conditions align, or you wait patiently with zero guilt when they don't. There's no middle ground. You don't kind of see a hammer candle. You don't sort of have alignment. Either the 1-hour chart printed a clear rejection wick at your key level with both time frames aligned, or it didn't. Either you have a defined entry, stop, and target, or you don't. This requires immense patience. You are a sniper lying in the grass, waiting for the perfect shot. You might watch the screen for 4 hours and see nothing. You might see the pullback, get ready, and then watch price drift lower and lower, invalidating the setup. It feels frustrating. It feels like wasted time. But it's not wasted time. It's professional discipline. If the target doesn't present itself clearly, you don't fire just to make noise. When you have your pivotal point, when all conditions align perfectly, you execute immediately on the candle close. No hesitation. No debate. No checking Twitter to see what other traders think. You calculated your risk. You identified your trigger. The trigger fired. You execute. This is the difference between having a system and being a gambler. The system tells you exactly what to do and when to do it. You simply follow the system with discipline. Most traders think their job is to predict what will happen next. That's impossible. Your job is to react to what is happening now with mechanical precision. The pivotal point is your green light at the intersection. If the light stays red, you don't drive. If the candle doesn't confirm, you don't trade. But once you execute that entry at $50.20 with your stop at $49.70 and your target at $51.70, the easy part is over. The hardest part of trading isn't finding the setup. It isn't calculating position size. It isn't even pulling the trigger. The hardest part is what comes next, sitting on your hands while the market does its work, resisting the urge to grab a small win or avoid a small loss. The hardest part is management, and it's where most accounts either slowly bleed out or quietly compound. That's what we'll decode in the next chapter, the final pillar of our ATM strategy. I will teach you the art of keeping your money, how to trail your stop without choking the trade, and why Jesse Livermore said that men who can both be right and sit tight are uncommon. You nailed the alignment. Both the 1 hour and 4 hour charts were screaming uptrend. You timed the entry perfectly, waiting patiently for the pullback to your key level, watching that beautiful hammer candle print with conviction at $50.20. You calculated your position size to exactly 200 shares, risking precisely $100 with your stop at $49.70. Within 30 minutes, price climbs to $50.60. You're up $80. You feel smart. You feel validated. The system is working exactly as designed. Then suddenly, a red candle appears. Price dips back to $50.40. Your profit shrinks from $80 to $40. Panic floods your nervous system like ice water in your veins. Your finger hovers over the exit button. A voice screams in your head, "Take this now before it disappears." $40 is better than $0. You've been burned before. Don't be greedy. You close the trade. You bank your $40 profit and feel relieved for exactly 90 seconds. Then you watch in absolute horror as the market consolidates briefly at that level and rips higher, climbing to $51.70 without you. You would have made $300. Instead, you grabbed 40 and ran like a scared rabbit. This pattern repeats week after week, month after month, until you realize the brutal truth. You're not losing because you can't find good setups. You're losing because you can't hold them. This is why management, the final pillar of our ATM strategy, separates hobbyists from professionals. Finding the trade is the easy part. Any decent trader can spot alignment and time an entry. Holding the trade through the inevitable fluctuations, managing your emotions while the market tests your conviction, extracting maximum value from your winners while cutting losers fast. That's where fortunes are made or squandered. This is the part nobody wants to talk about because it exposes the uncomfortable reality that your biggest enemy isn't the market, it's the voice inside your own head. Jesse Livermore understood this when he said, "Men who can both be right and sit tight are uncommon." Notice he didn't say men who can predict the market are uncommon. He didn't say men who can find perfect entries are uncommon. He said men who can sit tight. The sitting tight is the hardest part because it requires you to fight millions of years of evolutionary programming. Your brain is wired for immediate gratification and loss avoidance. When our ancestors saw a berry bush, they ate immediately because waiting meant starvation or losing the food to competition. When they sensed danger, they ran immediately because hesitation meant death. That same primitive wiring fires when you see green on your screen. Your ancient brain screams, "Take the food now." The predator might steal it. But the market doesn't reward primitive thinking. The market rewards delayed gratification, patience, and the ability to endure discomfort for larger rewards. The 1H ATM strategy uses mechanical rules to remove these biological impulses from your exits. These aren't suggestions or guidelines. They're laws that you follow with the same discipline you'd follow the law of gravity. Break them, and you fall. The stop loss is sacred. Before you ever enter any trade, you must know exactly where you are wrong. Not approximately, not roughly, exactly. For our hammer candle entry at $50.20, your stop sits at $49.70, just below that long rejection wick. That level represents the line in the sand where your thesis breaks down. If price trades through that low, the market is telling you with perfect clarity that buyers failed to defend the zone, that your timing was off, that this particular setup didn't work. Your job at that moment is not to argue with the market. It's not to widen the stop, because it's just a few cents more. It's not to remove the stop entirely and give it more room to breathe. That's not risk management. That's denial dressed up as strategy. When the market hits your predetermined stop, You execute it exactly as planned and accept the loss as a business expense, as tuition paid for market education. Think about two traders with identical entries. Trader A respects his stop loss every single time, taking his planned $100 loss whenever the market proves him wrong. Trader B moves his stop just a little on half his trades to avoid getting tagged. Over 100 trades, Trader A will lose exactly $100 every time he's wrong. His losses are predictable, contained, manageable. Trader B will occasionally avoid the stop and feel like a genius, but the one time the market trends hard against him while his stop is disabled, he'll eat a $500 or $1,000 loss that wipes out 10 to 15 normal winning trades. That single moment of indiscipline destroys his entire mathematical edge. Professionals treat small planned losses as business expenses. Amateurs treat them as personal attacks on their intelligence and ego. The stop loss is sacred because it preserves your capital for the next high-probability setup. Target minimum 2R. This is the mathematical engine that powers your long-term profitability. R represents your risk unit. If your stop loss equals $100, that's 1R. In our framework, we target a minimum of 2R on every single trade. Risk $100, aim to make at least $200. This isn't greed, it's survival mathematics. Let me show you why this rule is non-negotiable. With a 2R target, you only need to be right 40% of the time to be profitable. Let's prove this with concrete numbers. Over 10 trades, you risk $100 on each trade. That's $1,000 of total possible risk. If you win 4 trades at 2R each, that's 4 times $200, which equals $800 in profit. You lose 6 trades at $100 each, which equals $600 in losses. Net result, $200 profit even though you were wrong 60% of the time. Now watch what happens if you tighten your targets to 1R, because you prefer to bank something safe. 4 winners at $100 each equals $400 profit. 6 losers at $100 each equals $600 in losses. Net result, minus $200 with the exact same win rate. The only variable that changed was your exit discipline, and it flipped your system from profitable to losing. This is why taking quick profits just to feel good is slowly toxic. It might provide emotional satisfaction in the moment, but over a large sample size, it mathematically kills your edge. Professionals design their exits so the mathematics carry them even when their market predictions are imperfect. You can be wrong more often than you're right, and still compound wealth systematically. Rule 3. Don't choke the winner. This is the subtle trap that catches even traders who understand the first 2 rules perfectly. You enter correctly, you set your stop properly, you commit to a 2R target. But the moment you see green numbers, fear takes control. You move your stop to break even immediately, thinking you're being smart, thinking you're creating a risk-free trade. What you're actually doing is choking the life out of a potentially massive winner. Markets breathe. Even in the strongest trends, price oscillates. It moves up, pulls back slightly, moves up again. This is natural, healthy price action. If you move your stop to break even the moment you're up $50, you're giving the market 0 room to breathe. You're demanding perfection. You're saying the market must move in a straight line to your target without a single moment of hesitation. That's not how markets work. That's not how anything in nature works. The professional understands this rhythm. They keep their original stop in place until the market creates new structural evidence of trend continuation. For a long trade, that means waiting for price to make a new higher high and then form a new higher low on the 1-hour chart. Once that new higher low is established and price starts moving up again, then you can trail your stop to just below that new structural low. Now you're trailing with the market's own structure, giving the trend room to breathe while protecting accumulated profit. Trailing too tight is fear masquerading as strategy. It feels responsible and conservative, but it's actually the opposite. You're taking a high probability trade and turning it into a coin flip by demanding the market move perfectly. The tragic irony is that the tighter you squeeze, the more winners you'll choke out, and the more you'll reinforce the limiting belief that the market always stops me out and then goes to target without me. Here's the professional withdrawal protocol that balances profit-taking with letting winners run. When price hits your 2R target, in our example, That's $51.70, giving you $200 profit. You have two clear options. Option 1. Close the entire position. Bank the full $200 and walk away clean. There's no shame in this approach. You executed your system perfectly, made 2R, preserved capital, and can now deploy that capital into the next high-probability setup. Option 2 is more advanced, but also more powerful for wealth building. At your 2R target, you close 75% of your position and let 25% ride for potential home runs. In our example with 200 shares, you'd sell 150 shares at $51.70, banking 150 shares times $1.50 profit per share, which equals $225 realized. On the remaining 50 shares, you trail your stop using structural levels, often around the 1R profit level initially. This protocol accomplishes something psychologically powerful. It removes the agony of watching a 3R or 4R winner evaporate back to break even because you got greedy and held everything. You've already secured the majority of your planned profit. The remaining position is essentially playing with the market's money, not yours. This mental framework allows you to hold runners without the emotional torture that comes from watching large, unrealized profits disappear. Think of this approach as building a pipeline between your good trading ideas and your actual bank balance. You can have perfect alignment and flawless timing, but if your management is chaotic, if you exit based on emotions rather than predetermined rules, the money leaks out faster than good setups can bring it in. Professional management is the plumbing that safely moves profits from the market to your account without leaks. This is how you build wealth in trading, not by being a market genius who predicts every move, but by being a disciplined manager of risk and reward. You cut losses at exactly 1R. You take the majority of profits at 2R. You let a small portion run for the occasional 5R or 10R winner that makes your entire month. You repeat this mechanical cycle 50, 100, 200 times until the mathematics compound your account systematically. The amateur tries to hit grand slams every single trade. They swing for the fences, strike out repeatedly, and never build sustainable momentum. The professional is content with consistent singles and doubles. They take the base hit, advance the runner, score the run methodically. Over time, those singles and doubles compound into serious wealth because they never blow up, never give back months of progress in one emotional decision, and never violate their risk management rules. Picture building a house. The amateur tries to construct the entire structure in one day. They rush, cut corners, take dangerous shortcuts, and the building collapses. The professional lays one brick at a time. Each brick is level, each brick is secure, and over months and years they build something that lasts. Each trade is one brick. Each 2R win is one solid brick. You're not trying to get rich on this single trade. You're trying to execute your system properly, one trade at a time, until the accumulated bricks become a fortress of wealth. Management is boring. It's mechanical. It's repetitive. And that's exactly why it works. Excitement in trading usually costs money. Boredom usually makes money. If your heart is racing while you're managing a position, you're either size too big or you don't trust your own plan. When you master these three rules, sacred stop, minimum 2R, structural trailing, you stop caring about the outcome of any individual trade because you know the mathematics work over 20 or 30 trades. You know the process holds up. You stop watching every tick and let the market do its work. You become the casino, not the gambler. The casino doesn't care if any individual player wins or loses on any given hand. They care about the mathematical edge playing out over thousands of hands. That's your new identity. You're not gambling on market direction. You're systematically extracting money from high-probability setups using predetermined rules that remove your emotions from the equation. In our final chapter, we'll close the loop on everything we've discussed and address the deepest transformation of all, shifting from someone who chases $500 to someone who executes a process so disciplined that $500 becomes a natural, mathematical byproduct of professional behavior. Here's the final, uncomfortable truth that nobody wants to hear when they first open a trading account. The truth that separates those who compound wealth from those who donate it. The 1H ATM strategy is not a way to guarantee $500 daily. It never was designed to be your personal money printer. What this framework actually gives you is far more valuable and far more rare. It transforms you from someone who gambles on outcomes into someone who executes a process so disciplined that $500 becomes a natural, mathematical byproduct of professional behavior. Most traders live in a state of constant emotional whiplash because they have married their identity to today's result. Green day equals genius, validation, proof they've finally cracked the code. Red day equals failure, stupidity, evidence they'll never make it in this business. Their entire sense of self-worth fluctuates with every tick of price action. When your identity is glued to outcomes, you become a slave to randomness. You start making decisions based on how you want to feel, not based on what the market is actually telling you. This emotional fragility creates a predictable pattern of self-destruction. On winning days, they feel invincible, so they oversize positions, break their rules, take impulsive trades far from their edge. On losing days, they feel desperate, so they chase, double down, move stops, and turn manageable paper cuts into deep wounds. They move their stop loss because they cannot bear the emotional pain of being wrong today. They take profits too early because they desperately need the dopamine hit of a win. They oversize because they feel behind and need to catch up. Eventually, this emotional chaos leads to the one catastrophic decision that wipes out months of progress. Professionals operate from a completely different paradigm. They have undergone a fundamental shift in identity. They marry their process, not their P&L. At the end of every trading session, they ask 4 specific questions, and these questions have nothing to do with how much money they made or lost. Did I respect my 1% risk rule without exception? Did I wait for proper alignment across time frames? Or did I force trades in choppy conditions? Did I demand a clear timing trigger, my pivotal point, before entering? Or did I chase because I felt bored or afraid? Did I follow my management protocol for exits, honoring my stops, targets, and trailing rules? If they answer yes to all 4 questions, they consider the day a success, even if they lost money. If they answer no to any question, they consider the day a failure, even if they made money. This paradox breaks the amateur mind, but it's the foundation of professional trading psychology. You can lose money and be a good trader. You can make money and be a bad trader. Let me show you how this plays out in real life. 2 traders, identical $10,000 accounts, both ended last week with $800 profit. On paper, they look identical, but underneath, they're living in completely different universes. Trader A made his $800 through pure chaos. Monday, he risked $5,000 on a breakout setup with no stop loss because he felt confident. It worked, netting $600 in 20 minutes. Tuesday, he did the same thing and got crushed for $400, but held the position hoping it would reverse. Wednesday, angry and desperate, he went in with $6,000 on another hunch and got lucky again, making $700. Thursday and Friday were smaller gambles that roughly broke even. He ended up $800 and felt like a hero. Trader B executed the ATM strategy with mechanical precision. Monday, he identified perfect alignment between 1-hour and 4-hour charts. He waited for the pullback to his marked support level. He got his pivotal point confirmation and entered with exactly 1% risk, $100 maximum loss. His 2-hour target hit Tuesday morning for $200 profit. Wednesday and Thursday, the market was choppy. Nothing met his criteria, so he took 0 trades. Friday morning, another perfect setup appeared. Same process, same 1% risk, another 2-hour winner for $200. Friday afternoon, a third setup materialized and ran to 4R for $400 profit. Total, $800 across 3 perfectly executed trades. Same P&L, completely different futures. Next month, Trader A will likely blow up. He's reinforced terrible habits, taught his brain that recklessness gets rewarded. When luck runs out, he'll lose not $800, but $8,000 in a single over-leveraged position. Trader B will scale up methodically. He's proven his process works, built unshakable confidence in systematic execution. When his account grows to $15,000, he'll simply increase his 1% risk to $150 per trade. Same process, bigger account, proportionally bigger profits. This is why you must reframe your goals immediately. Not print 500 today, but execute 2 clean ATM cycles this week. Not never lose, but never lose more than my predetermined amount per cycle. When you shift from outcome goals to process goals, the pressure evaporates. You stop forcing trades, stop revenge trading after losses, stop grabbing profits too early out of fear. Let's close the loop on everything we've built. The 1H ATM strategy in plain language. Alignment means using confluence between 1 hour and 4-hour timeframes, never trading against clear market structure. Timing means waiting for pullbacks to key levels and demanding pivotal point confirmation before entry. Management means risking 1% maximum, targeting minimum 2R, and trailing stops only on new structural evidence. You won't print $500 every day. Nobody does consistently. Some weeks you'll take 0 trades because nothing meets your criteria. Some weeks you'll execute perfectly and still end flat because the market chopped sideways. But when you commit to this identity transformation, $500 stops being a desperate dream and becomes an occasional, logical outcome of disciplined risk management applied to high-probability setups. The rules are simple. Following them consistently is the hardest thing you'll ever do as a trader, because it requires conquering your own biology, your own fear and greed. That's why most traders fail. Not because they lack intelligence, but because they can't force themselves to execute simple rules when emotions scream the opposite. The few who master process over outcome, who choose discipline over impulse, eventually succeed not through market prediction genius, but through the compound effect of small, systematic edges executed with unwavering consistency. Your job isn't to chase more information or find the perfect indicator. It's to internalize this framework and execute it mechanically, one trade at a time. Cut losses fast. Size small. Wait for alignment. Enter only at pivotal points. Let winners breathe. Own your process completely. When you make that transformation, when you stop being someone who needs $500 and become someone who executes a process worth $500, the money becomes inevitable. Not guaranteed, but inevitable. And that shift in identity is worth more than any single trade will ever pay you.